Mr. Ramesh Damani is joining us right now. He's member BSC, a veteran really. Mr. Damani, thanks very much. It's good to see you back on the channel after a while. First, let me ask you, what is your perspective in terms of what's going on? What's really ailing the markets and the economy?
Hi Prashant, good morning. It's always a pleasure to be back on your show, so thank you for having me. What's ailing the market? I think markets tend to go through a period of nervousness. I think the proximate cause that most analysts will tell you right now is oil falls, market falls. The correlation is almost perfect, 0.9 to 1.0. It's almost that perfect out there. But I think when the market places such importance on a particular measure, whether it was inflation in the 70s or whether it was the tech boom in India in 2000, that the ability of that correlation to predict the future greatly diminishes. So I would suggest that this is the last leg of the market getting worried about oil prices falling. I mean, for countries like India, Japan, even America, it's almost an unmitigated boom. And I think the market's belief that a fall in oil prices will damage the investment climate, damage the the energy consuming countries, while truth in some part is probably misplaced. At least
the
for
fear
our country.
is that
Yes.
The fear is that this will spread deflation. Would you agree? Eventually.
I mean, let's look at it and say in the American context. I mean, deflation is happening because of a number of series, because commodity prices are going down, because, investment is not happening, because the Chinese bubble has burst, any number of reasons, and I'm no expert on these, but let's look at just the simple question of energy prices. I mean, in the US, energy prices are down from $4 a gallon to $2 a gallon. All right, so an average consumer driving 15,000 miles a year and a 30 mile per gallon fuel efficiency consumes 500 gallons or gets a tax rebate equivalent of a tax rebate of $1,000, about roughly $100 a month coming into his pocket, which is big money in India and a consumer economy like America. India, of course, benefits enormously the same way. So, that in fact will be an incentive for consumers to go out, spend, and get some confidence because they're getting more money into their pockets. Now, deflation is something that's far more global and far more macro that we have to deal with. Do we go like Japan in the last 15 years, basically deflationary, can't get inflation back up to 2%? Is there a problem like we have in Europe where there are more retirees than they're earning people, so that leads to deflationary because older people don't spend as much as younger people? I don't think I can answer those questions, but I can look at it from my perspective in India. And whether you look at oil, whether you look at corporate earnings, whether you look at liquidity, or whether you look at the trajectory for the years ahead, I think we are better positioned than a lot of other places in the world. And while there is some evidence to suggest what the bears have been saying, that we've entered a bear market, the way the prices have fallen, the way the market rallies very violently and then comes down, the way the market shrugs off good news and goes to bad news, I think that is probably not taking into account the entire evidence. I can't imagine a bear market taking place when the markets are so light in terms of F&O position, when interest rates are coming down, when commodity prices are giving a huge tailwind to a country like India. So, to me, it's, at best, suspect that theory. I think we'll go through this phase. There will be a shakeout. There may have been some excesses in the mid-cap area, as analysts have pointed out. But you see individual stocks will continue to perhaps perform well and actually do well over the next few quarters.
But there are concerns about growth as well, right, Mr. Damani? Very simple. I mean, that is one thing which people did not doubt really, as far as India is concerned. It was a given. The demographic, the young population, premiumization across categories, different product categories, services, etc. That was taken as a given. But is that really so? Should one doubt that hypothesis?
I see no reason to doubt that hypothesis at this point. I think, if you look at this quarterly set of earnings, as my analyst friends have pointed out to me, that depending on the data set you use, there have been a year-on-year growth of between 5% and 12%, taking a total of the 500 companies that have reported earnings so far. The top line has been challenging for a lot of companies, but we're seeing growth. We're seeing growth, as you earlier referred to, in airlines. We're seeing growth in, say, cement. We're seeing growth in auto. We're seeing growth in pharmaceutical exports. We're seeing growth in railroad tenders, in road tenders. So, there is just, while the market is exhibiting some signs of fear and some signs of chaos, at the underlying, I'm not, I can only answer for my target group of companies that I track. I'm hopeful that the majority of them will report good earnings this quarter. They will, in fact, do much better a year from now in terms of growth and in terms of, earnings growth. So, I have reason to be optimistic. I have reason to look forward to the results rather than not look away from the results. Yeah, the world is changing. So if you're betted on commodity companies, you're seeing a different picture. But part of your job as an analyst is to figure out what will work over the next, 2 quarters, 3 quarters, in fact, 2 years or 3 years. And there's one thing I can assure you that, bear markets don't begin like that. I mean, they begin when the markets are very heavy. There's a speculative, overreach in the markets. In 2008, the feel of the market was completely different than the feel I get today in the market. And while it has been very violent and has been very painful for a lot of investors, I think, at least what we are doing is we're using the crisis as an opportunity to find or to load up on stocks that we truly believe in. So that's my, 2-minute version. I'm not sure it's, is very, very helpful. A particular point, market could go down another 5%. Who knows? These things happen all the time in the world. But at least from the perspective of, watching the market for 20, 30 years, I don't see the market, collapsing like it did in 2008 or in 2000 or 92. I just don't see the evidence of that yet.
What about a situation emerging similar to late 2013? There was a bit of a currency scare. Rupee got to 68. Now, the common defense against that question is that the macroeconomic situation is far more stable. And it is, no doubt, absolutely no doubt. But is it possible that we get to those kind of panicky lows? Because if you look at growth, earnings growth, etc., there hasn't been too much growth since then. From that quarter to this quarter, the third quarter of financial year 16, numbers for which we are still getting. So one could make the argument, or no? You think that was an extreme panic, unlikely to repeat?
I mean, to be honest, that was an extreme panic in the market. Is again something that, I didn't quite grasp the sheer magnitude of the panic that took place out there. But as you're saying correctly, a lot of reform mechanisms have been put in place after that. The current account deficit has been controlled. Interest rates have turned positive in India for the first time. Real interest rates are positive. GDP is still growing at 7.5% in a world that can't grow even at 2%. Oil prices, which is a huge bugaboo. I mean, it used to be that when oil prices went, Indian markets tanked, and the reverse when oil prices went down. You can't tell me that the situation of economics is reversed so badly that despite getting a benefit from oil prices going down, we're going to see the index go down and substantially and then remain down after that. I think the market will adjust to the fact. I think the more proximate cause that I would believe to explain the volatility at least is the fact that a large percentage of our holding is owned by sovereign wealth funds, and because they are facing pressures at home, they're selling to create liquidity for themselves at home, and that has been causing the market to fall, and that again has been witnessed by the FI selling numbers, which seems to have been more pronounced in the last few months, adding up to this. But the point I'd like to make, Prashant, is that markets exist on difference of opinions. That just because someone sells doesn't mean that the stock is going to go down. There'll be someone else who come back and say, oh, this is a great bet, or this is a great opportunity to go and buy something. So my sense is that, especially in this kind of bull market that we are in, that if the sovereign wealth fund sells, the domestic mutual fund, who has been plowing in $1 billion a month into the Indian equity markets, will step in and take their place. Markets will cease to function if we don't have difference of opinion. When people sell, they don't sell into a pit. They sell. There's always a buyer for the stock at the other end of the trade. So I think if there is continuing selling by the sovereign wealth fund, at some point domestic investors will step in and buy, because they know India best. They are more familiar with Indian companies. They realize you're getting tax-free dividend yields of 3% and 4% as opposed to, poor rates in fixed deposit. So they'll come in and step and buy. So I think the fear that sovereign wealth funds will come and sell and there'll be no buyer in India, is unlikely. I mean, if that happens, it happens like China, it goes circuit down. But I think when the markets trade normally, people readjust the risk ratios and, they step forward to the plate and buy. I mean, I see no reasons why Indian consumers won't see the companies or the basket group of companies and say, I want to buy a cement company, I want to buy an aviation company, I want to buy a road construction company, I want to buy an FMCG company. I mean, that's the way the markets function. So unless economic policy is going to turn on its head and people aren't going to work on difference of opinion, I think there'll be a more nuanced approach to value as the few months progress ahead.
No, I mean, absolutely. There will be buyers, but at what price, right? That's the point. The sovereign wealth fund point that you made is interesting, Mr. Damani. The total stock of FII money is about $300 billion in India. Direct investment from sovereign wealth funds is about $30 billion. And of course, they come through other routes as well. But direct investment is $30 billion. I spoke with the Saudi finance minister at the World Economic Forum in Davos, and I asked him this question. Are you selling? Is the fund selling? The sovereign wealth fund selling? Saudi Arabia was a large fund affected by the fall in oil prices. And he said, we have not sold anything. I hope he's telling the truth. But it's possible that some others are selling, right? I just want to come back to one point you made earlier about the fact that bear markets don't start like this. It reminds me of a conversation I was having last week with someone. And the gentleman was saying that in 2008, there was a bubble and that bubble collapsed and then we had a big crash. And he described the current situation as no bubble.
Correct.
And the market just caving in. I mean, I think that was a kind of apt description of what's going on. Why do you think this is happening? I mean, if India is not a new story, which will take time. People know, large funds are here, everyone is here. Why do you think a market is selling off like this then?
Prashant, these are, difficult questions, but, I think the point investors need to understand is this: volatility is the nature of the beast. That is the nature of markets. For the last 2 years, particularly in the Dow in America, has been the least volatile period in a number of years for America, when it moved up and down in a range of 4 or 5%. But markets typically are very, very volatile. And what investors need to distinguish always is between volatility and risk. Risk is what we define as a chance of a permanent loss of capital. Volatility is something that we want to take advantage of, that markets will bounce up and down, and when the market acts stupidly or misprices something, we will step in and buy. So my sense is that we're going through a huge burst of volatility in India, all right? Not risk. I don't believe that if you buy good quality companies, you have a permanent risk of your capital erosion. Yes, there is volatility, and we all have to face that. But typically, I mean, there are lots of reasons in the world not to buy a stock at any given time. In the last 30 years I've been in the market, there have been so many crises. There have been Kargil in India, there have been the Gulf oil crisis, there have been plagues in India, there have been earnings recession, dot-com bubbles burst, interest rate raise, whatever. But there is one reason to buy stocks, which is universally true, that over the long run, stocks outperform inflation. In India, if you go back to the Sensex history, it's outperformed. Sensex is up by about 16-17% compounded without dividends. And for the better part of the last 15 years, it's been tax-free. So you can do all you want, but the fact of the matter is that equities offer a great option. And generally, people who tend to make money is buy when there's panic on the street, buy when valuations are cheap, and are happy to hold these businesses for a period of time. If you want to flip paper, you want to trade the markets, that's a different subset, and I'm not addressing my answers to those. But to an Indian investor who's shaken up, I say it's the volatility, and volatility is the nature of the market, and you should go and step and buy good businesses that you understand.
Right. Just to go back to the point about volatility, the difference between volatility and risk, of course, we're all wiser with the benefit of hindsight. 2013, of course, was a great time to buy stocks, right? Markets rebounded very quickly. And there was a lot of money to be made off that panic low. And the only point I'm making is sometimes markets are, the way markets behave, we say that, well, they are lead indicators. But the trick is to, I'm sure you'll agree, is to differentiate between when they're telling us something and when it's just volatile movement and it's not really reflective of the underlying situation. To many old-timers even, Mr. Damani, it would seem that the current situation, this caving in I spoke about, is telling us something. It's reflective of the underlying situation, that something is wrong. And we all know the issues, right? For example, bank NPLs. I was reading this morning a sell-side report from a mainstream large global bank. For the first time, this analyst is saying that, and this is off the back of the RBI governor's conference call. He said maybe the actual level of NPLs in the system is 3 times what is reported for the entire banking system. Now, these are fundamental issues. How would you respond to that?
Well, I'll take it in parts. The first thing that 2013 that the point that you raised again, the 2013 was the end of the bear market that began with, 2008, and a new bull market started as the market anticipated economic recovery, a new government in Delhi, and, all the things that go with it. So 2013 was very scary. I'm not denying that. But having said that, if you believe that the bull market started in 2013, we have to evaluate its trajectory and see whether that it's still alive or that it's dead as the cycle played out. I'm submitting to you that while there is some evidence that the bears say that the market is shrugging off bad news, for example, good news, for example, and reacting to only bad news, that global liquidity is at a premium. So there is some evidence out there. But I think if you judge in whole, in totality, if you judge, that you will feel that this is just a vicious, volatility-led shakeout in the market, rather than a permanent, return back to the means. That is at least the assumption that I am going on at this point out here. So now to answer the other parts of the question that, what do we do from here on? I think, the budget will give us some directions. I think Mr. Rajan has, laid out the groundwork that are we going towards a path of, fiscal expediency, as some people have suggested, so interest rates won't go down, or are we going to, reorient to make it a smart economy? For example, if we do disinvestment, if the government actually bites the bullet and raises 50,000 crores a year that they promise for disinvestment, that would help. That would help tremendously. But, we'll have to see the choices the government makes. I think this is into the third budget, so we'll have some, radical choices available by the government. And we'll, evaluate it from, that perspective. But there is no reason, I think the market is just, in my opinion, reacting in a knee-jerk fashion, markets occasionally tend to do this. There's no particular reason for it. They just get nervous. I think we're going through this kind of a phase. But what I realized over the last 30 years of my career, that people who lose their head tend to come out ahead. People who don't lose their head tend to come out ahead.
Okay. Fair enough. So keep your head in times like this. Just one point. So, you said that if local investors will step up and buy, they'll buy if they continue to get money from retail investors, and they've got a lot of money, right? $1 billion a month has come into equity mutual funds, although it started to come off a little bit. The peak was June last year, July last year. December was about $800 million. In the next few days, we'll get the number for January. The retail flow, that is. Are you picking up any evidence of that slowing down, or even redemptions starting? Because that will be it could be the next pain point. I mean, hypothetically speaking, if FII still don't buy or remain sellers, and there is trouble here on the local side, I don't know.
Well, see, these doomsday theories go around, but like I told you, it's like, suppose you buy a flat and you assume that everyone in the neighborhood comes and sells the flat tomorrow. Obviously, prices will go down. So, should you be paralyzed and not buy the flat because of that? I don't think so. I think, like I explained to you, that markets work on difference of opinions. You're going to get stocks right now. You can build a basket of stocks, A group, high quality companies at 3 to 4% yield, tax free. All right. Now, let's say they sell off and you get to 5% yield. Are you still not going to step up and buy? That's just, that's not the way economic analysis works. So, it could happen. Yes, of course. And if that happens, if domestic sales, retail sales, Indian institutional sales, we'll have a circuit down in the markets. I have no doubt about that. But I'm not predicting that. I'm not calling that. I think markets will work on difference of opinion. There are a lot of companies in India that are going to do well, that as I speak to you today, they are 3% and 4% yields, tax-free yields. All right? If the stock goes down another 10-15%, the yields will start climbing on these shares. All right? Now, I can't imagine this country which, people are going to pass up on a chance at a 5% tax yield, tax-free dividend yield on stocks. So, I think it will sort itself out. I'm not saying there's no more pain ahead. We might test the lows we made 2 weeks ago. Any number of things can happen. But as an individual investor, it's your job to look at individual good companies that you're comfortable with, that you're confident with. And I'm finding plenty of those, trust me, across the mid-cap section. In fact, I look rather aggressively at the mid-cap section. And, I see no reason to be wary of my company's results 1 year from now, say, for example. So, yeah, some commodity companies, some oil companies will remain under pressure. But, that's your job. I mean, if his job as an analyst is to look and find for bargains, I see no reason to suggest that earnings will be poor 1 year from now, 2 years from now, that everything will be in much poorer shape. So, you stick to your guns. You make a mistake, then I'll pay for a price in terms of losses. But at this point, I can only suggest that that's the strategy that I'm following.
I know putting numbers to a market is prone to a fair amount of risk, but would you say, for viewers watching this, I mean, some sort of a mental comfort number, 7,000 could be that number? You'd think, well, markets will not, that's about 5% from here.
Correct.
That markets should respect, or? Mr. Damani, can you hear me? Okay, I think we lost Mr. Damani there. I'm just going to go back to him as soon as we have the line with us. Just a bit. Bear with us. What's happening on the Nifty? I think we're down about 60 odd points or so. The Sensex is down about 190. So we're still there. No real recovery or anything. But it's not selling off. It's not a one-way market. And it's not a trending market on the downside. So I think that's the good point. Mid-cap index is down 1. Small-cap index is down 1 1/3. The Nifty next 50 is down about 0.6 odd percent, 0.7 odd percent as well. The top losers are up on your screen. Kane India is down 3.5. BHEL is down 3. Tata Power is down 2 1/3. What else? You got ONGC down 2 1/3. Tata Motors down 2. SBI down 2. So these are some of the top losers which are coming up. Do we have Mr. Damani back with us? Okay, I think we have him. Okay, Mr. Damani, sorry about that. We lost the line there. Just last quick couple of questions. I know index targeting is kind of prone to risk from the moment you do make those predictions. But for our viewers, would you say another 5 odd percent from here, that's the risk? I'm still going to press you on that. So 7,000 odd? I mean, a mental stop?
No, I'm going to, take up what you said in the first part. I mean, it's just, I can say it and fill some airtime, but I also don't believe that. I would also take it with a huge grain of salt. But take this opinion, that the index has compounded at 18%, and there is no evidence that I can see, Prashant, that the bull market has ended. It's going through a hugely volatile phase. It's going through a huge difficult phase. We might spend 6 more months like this before we move ahead. But if you're doing bottom-up stock picking, by all means, I would step up to the plate and do it. That's the best vote of confidence that I can give. Nobody has ever been able to figure out the market's going to have 5%, 10% or go down 10%. But, I feel reasonably confident that I will make money on the investments that I'm making at today's prices in my basket of companies.
Okay. You said you're finding a lot of opportunities. Would you mind sharing a few ideas with us?
Unfortunately, because of SEBI regulations, I can't do that. But let me just suggest a sector that I think investors should start looking at, because I can speak about sectors more openly. I think one of the things that the government is trying to do in this budget, Prashant, is that they're trying to make India a more, to use the euphemism, a more white economy than a black economy. So to bring economic transactions under the purview of, officialdom. So everyone reports the income and expenses, and the government is a way to track that. So one move of that is to move from the physical currency, which of course can be untraced, to a digital currency, which of course everything is tracked. What you spend on, where you spend on, everything is tracked and placed out there. So there has been some suggestions, including by people like Bill Gates, that we will move from, a completely cash-driven economy to, say, in the next 5-7 years, 30% of our transactions will be digital. So which means that two powerful forces will be married in this economy. One will be, of course, the Aadhaar card or identity, because anytime you move to a digital economy, you need to prove your identity. An Aadhaar card with now 100 crore people in it is at the tipping point. So I think that will be used. And you marry that with the almost explosive growth of smartphones that is taking place in India, you will see that when you marry Aadhaar and the smartphones, a lot of people will move around and pay 5 rupees to the newspaper wala, 500 rupees to kirana person, or 200 rupees for a restaurant meal through digital payments. So I think companies that can, marry these two technologies, or, can do data mining of these technologies, will probably be well placed over the next few years. As India moves from a totally cash-based economy to a digital economy, whether you're getting subsidies electronically into your bank account through to your smartphone, or you're paying for services through digital economy, I think that will be an explosive area for growth. I would tend to look at companies that have built expertise around these areas.
All right, fair enough. Just one last question. Many of, it's obviously unfair to generalize about anything in the market, but I guess at extremes we can risk a bit and generalize. Do you think large caps are, for mid caps, it might be over for a while? I'm generalizing, I know, because large caps themselves, in many of the same businesses, the leaders, they themselves have gotten a fair bit cheaper.
I know large caps, a lot of large caps have come down to what I call astonishing valuations. And I would look at them. I would look at mid caps, I'd look at large caps. I like to think of myself, Prashant, as cap agnostic, that I like to buy companies that, make good sense, despite whether they're considered large cap or small caps. And as I look through, I find good values in either of the sectors. So I would say do more bottoms up. I think that will help you more than trying to say I want to be large cap, small cap, value cap, whatever. I think do bottoms up. Try and figure out how the company will be a year from now than they're today. I think that probably is a more rewarding exercise.
Mr. Damani, thank you very much, sir. Good speaking with you. It's a pleasure, as always. Thanks indeed.